In today's video, we are going to break down a whole life insurance policy and look at a lot of details that people are often interested in. We're going to focus on someone who we are working with right now that is very analytical by nature, and he's going to look at a lot. He wants to see the non-guaranteed values when he looks at different life insurance policies. The guaranteed values. He wants to know, should I go with a term rider or not? What are the net returns on the policy? And then also, what is my taxable equivalent? So we're going to look at all this, but we're really going to dive into the details. A little bit about him. He's really good with numbers. So he is a financial analyst. He is in the financial services industry, and he's got several designations. So we see CFP, CFA, CAIA, which is kind of like the CIA. Not really, it's not at all like that. But here's what these stand for. CFP, you may have heard of this one, Certified Financial Planner. Then you've got CFA, which stands for Chartered Financial Analyst. And then you have CAIA, which is Chartered Alternative Investment Analyst. All of that means he's very, very good with numbers. He's a very fast-paced individual. I've actually worked with him for a number of years, and he looks at something, gets it, and then wants to move on once he knows that it is truly set up in his best interest. Because he's in this business, he has a lot of insight before him and I even connect. So he's interested in a whole life insurance policy. His goal is to get the most cash value possible. Now, what he's interested in is funding a policy with a total dollar amount of 400 grand, and how he wants to move that into a policy is at $100,000 per year for the next 4 years. Again, he's interested in getting as much cash value as he possibly can with the insurance product because he views the cash value as a fixed asset. So he views it, and a lot of people view it this way, a lot like a municipal bond alternative if you position it correctly. He really likes the tax benefits, or if you do everything correctly, you can easily use the cash value tax-free. We'll look at this later when we hit on the taxable equivalent piece. And then also the loan feature is very attractive to him, where he can use the cash value as his own personal line of credit to use it for financing for potential real estate deals in the future. So his goal, getting as much cash value as possible, and he wants to see all of this, which we're going to get into in detail. So a little bit about him. He is currently 42 years old. We're looking at $100,000 per year going into the policy, getting as much cash value as possible. Here's what's important. If you're interested in a whole life insurance policy and cash value is your goal, typically what you want to let an insurance company or an insurance agent know is that I want the minimum death benefit possible. Because by minimizing the death benefit, you're going to minimize your costs, and then more of your payment, in this case, 100 grand per year, can be allocated toward the cash value. That's going to give you the most money. Now, there are some tax laws here. Remember that point where he mentioned he's interested in the tax benefits? If you do everything right with a life insurance policy, you can access the cash value tax-free. You can mess that up. So there's what is called a MEC. MEC stands for Modified Endowment Contract. Any life insurance policy can become classified as a modified endowment contract. If it does, you have a taxable event. What happens is if you want to access your cash value, you're going to have to pay ordinary income tax on the gains and a potential 10% penalty tax if you touch it before the age of 59 and a half. No one wants that. So how you prevent that modified endowment contract, every policy has what is called a MEC limit. Without getting into further detail on that, for a 42-year-old individual with the product that we're going to look at, he needs just about $2 million in total life insurance in order to be able to have a MEC limit of $100,000 per year. To simplify that, that means the death benefit on his whole life insurance policy needs to be $2 million to give him a permission slip to add $100,000 per year to the policy and still be able to use it tax-free. Make sense? Cool. So what we're going to look at are two options with his policy. The two options are A and B. A will be a policy without a term rider. See that question in the center? Should I get a term rider or should I attach it to my policy? What we'll look at is an option without a term rider and then the exact same product with the exact same company with a term rider. This will be the first thing we'll look at. And when we look at the term rider, what we want to look at here is what's the cost. Specifically, the cost based on the current rates and then also the guaranteed cost. And what that means, the guaranteed cost, is if I attach a term rider to my life insurance policy, I'll have what is called a current charge, which is what the insurance company is currently charging for the cost of the term insurance rider. That's usually what the cost is. We typically don't see it vary too much from that. But then you have a guaranteed cost. What this represents is the maximum dollar amount that an insurance company can charge for that term insurance rider if they want to. While it's rare, they still have to disclose it. So we'll see exactly what that is in his case. And what we're going to look for, bottom line, which option gives him the most money? Meaning, what's going to show him the most cash value? Option A, without the term rider, or option B, with the term rider. So that's the first thing we'll look at. The second thing we'll look at is the cash value. We'll look at both the non-guaranteed and guaranteed cash values. And then we'll look at the net returns. And we'll have a nice bonus here if you like analyzing things like him. We'll see how we can analyze the returns, specifically the annual rate of return and also the internal rate of return. And because of the tax benefits that come with the life insurance policy, we're also going to look at a taxable equivalent, and I'll show you how you can look at the taxable equivalent depending on your tax bracket, which will be pretty cool. Full disclosure, none of this is meant to be financial advice. This is all meant to be educational information. Please enjoy. All right, so let's begin with point number one, the two options we've got. Option A, without a term insurance rider. So he wants to pay in $100,000 per year. When I have a life insurance policy, where can my money go? My money can go toward the insurance premium or toward my paid up additions rider. Those are the two primary areas. So if I'm not adding a term insurance rider, the minimum base premium that I will have with this policy with $100K per year going in will be $37,000. That will get me a total whole life death benefit of about $2 million. And this is assuming we're paying a total of $100,000. So, key takeaway, $37,000 base premium gives me a $2 million whole life death benefit, and that $2 million whole life death benefit gives me a MEC limit of $100,000. I know that can be complex. Let's look at the actual illustration from the life insurance company. So here we go, 42 years old, preferred plus health rating, male, age 42, preferred plus. What did he want to pay into the policy? $100K per year for 4 years. After that, nothing. So of that $100,000, this is the question I would ask if I'm him, where's my money going? Because it can go toward the insurance premium or toward what is called my PUA rider, which stands for paid up additions, which is right here. So that $37,000 minimum premium, it's kind of an oddball number. Where we came up with that, that's about the minimum we could set the premium at without adding a term insurance rider. That's high, in my opinion. Well, it's high, period. So a $37,000 minimum premium. What's the impact? Like, what does that do to your bottom line? You pay $100,000 in. Look at this column here. There's your cash value. First year, you're at about $63,000. Would you do that? What didn't show up in cash value? The premium piece, $37,000. The premium does not show up in cash value in the first year. The second year, you pay $100,000, you get the full 100 back, which means you're getting the premium back and the PUA. But the first year doesn't show up in cash value. The company is overcharging me for the cost of insurance up front. We can look at the cash values and death benefit long term, but we're going to look at a comparison in a little bit. Death benefit, just about $2 million. That gave him a $100,000 MEC limit. So this policy is designed to handle $100,000 per year without a term insurance rider. That's the purpose of it. Okay, let's continue on here. Option B, with a term insurance rider. What we're going to do here is set the minimum premium as low as we can. It's just about $9,100. However, that gives us $500,000 of whole life death benefit. The problem with that is that $500,000 in whole life death benefit gives you about a $25,000 MEC limit, which means we can't pay the $100K in. So if you ever ask for a minimum base premium when you're speaking with a life insurance agent and say, can I go lower? Sometimes you might hear, you can't go that low because it will MEC. Does that mean you're forced to have a higher base premium? It does not. So what he can do is add what is called a term insurance rider, which means you're going to add more death benefit to your policy. So your whole life death benefit based on the $9,100 premium was $500K. Then for about $600, you got another $1.5 million in term insurance. What does this do? Well, that $1.5 million in term insurance gives you additional MEC space of $75,000. So take the whole life death benefit that was generated from your premium that you minimized, $500K, plus the term rider, add the two together. Now you have a $2 million death benefit, which gives you a MEC limit of $100,000. Would you like to see an example? So, in this example, same $100K per year going in. Here's your premium. That gives you a death benefit. We had $500,000. It's about $430 in this example. Then you've got PUA, absolutely stuffing this. And then we've got your term insurance. So here's the term insurance amount. They call it target additional benefit, but here's the cost. Just about $600. And an important side note, this PUA of about 91 grand, the $590 for the cost of the term is taken from that PUA payment. So we can refer to it as a blended PUA rider. And OYT over here represents 1 year term insurance. Why we like this term rider a lot is because it opens up the limits as far as how much you can add into your PUA rider and allows you to reduce your base premium. That's how you maximize the cash value when you look at a whole life insurance policy. This is exactly how corporations do it. So, as we look at this guy, 100 goes in. Instead of 63,000 in cash value, you've got 88,000 in change. The death benefit is $2 million because it gave you a $100,000 MEC limit. A lot of technical stuff here. We're going to start to look at the comparison now. But we wanted to show a comparison of the same product with the same company with and without a term rider so we can see the difference. And the reason why is this. A lot of times when people look at whole life insurance products, they don't like a high base premium. The reason why is because it takes the biggest bite out of your cash value, especially up front, and for a business owner or someone that is interested in using the cash value for real estate, that's a huge lost opportunity cost. A lot of people don't like that. But then on the flip side, when we attach a term rider, sometimes we hear the term rider causes drag over the life of the policy, and you'll have less money as a result. is that true? Before I just give you the answer, we'll look at the numbers to show you some proof. So let's look at it. And again, he wanted to pay $100K per year for 4 years. Let's take a look at the comparison. So we're going to look at the two illustrations we just reviewed, but we'll look at it on Excel. So what do you notice? This is the policy without a term rider. Your base premium is $37,000. Next, you've got your PUA rider. That's the difference, $63,000. Add the two together, there's your $100K per year for 4 years. And then you notice this. What's going on here? Your premium is still due years 5, 6, and 7. You are not paying it, but it is still due. Premium is going to be due for the first 7 years. Remember that MEC limit? Another name for the MEC limit is the 7-pay test. Has to do with the first 7 years of a policy. We can't reduce the premium during the first 7 years. Otherwise, it'll reduce the death benefit and trigger a MEC. So the premium has to stay there, but he doesn't want to pay it. He wants to optimize the cash value. And funding it for 4 years, even when we don't pay that premium, still will optimize the cash value, just when we look at maximizing the overall internal rate of return of a policy. But he's not paying that premium for 3 consecutive years, which means it is going to drag on the cash value performance. That's the main thing that I want to take away from that. So he paid in 400 grand. When did he get his money back? 1, 2, 3, 4, 5, 6, 7. By the 7th year, his cash value has finally reached $400,000, which means he's run a loss for the first 6 years. First year is the worst year. That's a $40,000 hit almost. That's a lot. I'm not comfortable with that if I plan on using the money for my business or anything. But this is without the term rider, this particular example. We can see the death benefit there too. And what you will see is after the funding period, death benefit gradually comes down. And then when we eliminated the premium in the 8th year, we see a big drop in this particular example. So again, that is without the term rider. Let's take a look with the term rider. So what do you notice here? Well, your base premium is that $9,100 figure, a little bit less actually. And you'll also see years 5, 6, and 7, you're not paying it, so it's paying for itself. Then you've got the term insurance rider. And this again is a 1-year term rider. So the first 4 years, minimum base premium and the term cost would be the true minimum out of pocket. There we go. Then you see what's going into PUAs for the total of $400K per year. So for him, it's all the same. He just puts in 100 grand per year, but because of his nature, being a very analytical individual, he wants these details. A lot of people do, especially when they're trying to figure out if their policy is truly set up for maximum value. Now when we look at the cash value, when does he get his money back? Much earlier. Between years 3 and 4. He's close at year 3 when you look at it. He's at 296 and change where he's paid in 300. 4th year, he's cash positive. What about after the 4th year? He pays in 0. Here's the objection we hear around a 1-year term rider. That if you leave this rider on, it's going to create massive drag on the policy and it can blow up like a universal life insurance policy. It's like, no, you just chop it off like we're going to do here. And if you want to keep it on for some time, you can always reduce it as well. The only way that term rider blows up is if an agent is irresponsible. So here we go. Whole life death benefit plus the 1-year term insurance rider equals the net death benefit of $2 million. Where would we come up with that $2 million death benefit? The MEC limit of 100K. That's the reason why. But how that term rider works is as we're funding the policy, your whole life death benefit goes up, and your term comes down every year, which is good. Nice. And then after the 7th year, we chop it off altogether. If you wanted to fund longer than 7 years, we would keep the term rider on for that period of time. So here is our side-by-side comparison. This is based on the non-guaranteed values. So going back to our whiteboard, right, we're looking at option 1 as we're reviewing the costs of the current costs presently. But then down here, the cash value, we just looked at the non-guaranteed values. Which one had more money? Do you know which one? Here you go. Cash value difference will show how much more the same product with the same company with the term rider you have in cash value. So it'll show how much more you have in cash value with the option where you attach the term rider. And we can scroll down, but the gap just gets larger and larger over time. So from start to finish, by reducing that premium, we have more cash value, even with that term insurance rider. Now, what happens if we look at the guaranteed values? Because this individual is an analyst, we want to have that information ready for him. So what you can do is run additional reports with any illustration, with any life insurance company illustration software, and that's exactly what we did. So now we're going to look at the guaranteed values. Let's have some fun. So what do you see here? Well, doing the same thing, there's your policy without the term insurance rider. You notice 37 base premium, 63 PUA. Okay, that's great. Then you've got the cash value. So just to emphasize this point, this is based on the guarantees. When I look at the guaranteed values, the first year is the same, about $63,000. What happens to your cash value when you don't pay anything years 5, 6, and 7? You don't pay anything, cash value goes down. Meaning based on the guarantees, the policy having to cover that premium internally, meaning the cash value is covering it, the $37,000 it's paying for is exceeding the interest earned within the policy. That's why you're going backwards. It's not very much, but we are going down in this example, which is important to be aware of, obviously, because it's our money. Then you've got the death benefit. You see that going down at the same time, but it never dips below that $2 million amount, which means we don't run into a mech until after the 7th year, then we're in the clear. And because it's based on the guaranteed values, that death benefit will not go up unless we're adding PUAs. But if I'm not getting any dividends, I'm just going to have the guaranteed death benefit. Look at your break-even point. Not that attractive, is it? It's between years 14 and 15 when you look at it before you're cash positive. By going with a minimum base premium without a term insurance rider. You think he wants this option, being very analytical by nature and knowing numbers in the financial services industry. I wouldn't, knowing what I know. So here's the same product, but with the term insurance rider, $100K per year. Base premium is the same as the non-guaranteed values. Look at your term rider though. What happens beginning the 3rd year? Those term costs go up. This illustrates the maximum allowable amount that the insurance company can charge for that term insurance rider based on the dollar amount there. Now, if he paid in less, he'd have more term, which would result in a higher cost. Do you think those costs, though, during the first 7 years, the base premium plus the term, are ever going to equal $37,000? No, they're not. So adding a term insurance rider is a cheap way, if you don't like the word cheap, a cost-effective way to add more death benefit to get you to the MEC limit you want in this example, of 100K. Remember, the whole play here is to give him a permission slip to fund up to 100K per year, and he wants to do so in the most efficient way possible by reducing the insurance expenses as much as we can, which is exactly what we did. And look at this. This is the guaranteed values. I want to emphasize this point. Guaranteed values. When's your break-even point? Based on the guarantees between years 6 and 7. The non-guaranteed values, without the term rider, broke even at year 7. So I'm getting my money back faster. And if I ask that question, which one gives me the most money long-term, what's the bottom line? What do I see? Well, the guarantees are even more drastic. I've got more with that lower premium. So analyzing the policy, with and without a term rider, with both examples maxed out with the same product, what do we see? The option with the term rider produces significantly more value for him, which is exactly what he's after. So what do we look at so far? The two options, A and B. B is the winner. We reviewed the current term cost, the guaranteed term cost, which was very minimal, even when we looked at it based on the guarantees. Then we saw the cash value. We got to see the non-guaranteed values and also guaranteed values, comparing both options A and B together. And then we got to see the net returns. Or, I'm sorry, we didn't get to see the net returns yet. Let's look at the net returns. So how we're going to do this will be fun. We're going to go back to our workbook here, and we can take any of these illustrations and drop them into this workbook. So let's take the good one, shall we? So we've got 100K per year for 4 years. Take our cash value. We're going to copy it and drop it in here. Then that was the guaranteed cash value. Let's look at the guaranteed first, actually. Then we'll take the death benefit and drop it in. So now he can see, based on a worst case scenario, what do his numbers look like? Let's make this a bit bigger. Okay. So again, this is based on the guarantees. What do we see? We see 100 per year for 4 years. Break even between years 6 and 7. Annual rate of return displays the net rate of return. The guaranteed cash value interest rate is 3%. Does it ever earn 3%? No, it does not. Peaks at almost 2.6% when I look at it. Anytime I see a crediting rate with a life insurance product, whether it be the guaranteed rate or dividends, that's never going to be the net. It's always a gross rate that is applied, and then after the company pulls out their insurance expenses, I'm left over with this, which is just my annual rate of return. But then we've got our taxable equivalent. And this is based on a tax rate of 35%. So what this is telling him is, if I look at age 50, when I earned 2.57%, because it's in a life insurance policy, and we're assuming we don't do anything to trigger a taxable event, at a 35% tax rate, I would have to earn 3.95% in an account that is taxable. And then after I pay the taxes of 35%, I'd be left over with the 2.57%. Now, with that said, if he said, I'm not in a 35% tax rate, I'm at a 20% tax rate, well, we would just change that, and the numbers would update accordingly. If he said, no, I'm in a 40% rate, like I'm near the highest, the higher the rate is, the more powerful the returns are in a life insurance policy, because again, I've got that tax benefit, assuming we don't mess it up and trigger a taxable event, which is really on the agent. But the annual rate of return just measures what you're doing in performance in 1 year. And then the internal rate of return is more of an average. If you're in real estate, you know what that means. It's accounting for the cash flows you add into the policy, and then the cash value. It's looking at more of a net present value. You can think of it, it's more of an average growth rate. That's the easiest way to explain it. But with this, you'll notice you're negative until the policy breaks even. Once you have more cash value than what you paid into the product, then the IRR is positive. So this again is based on the guarantees. And for someone who is very analytical, like he is, where this was helpful, is he can see both a worst case and current case. Want to look at the current? Yeah, let's look at the current. So what we'll do here, take the cash values, drop them in. There we go. And these reports too, by the way, like this return workbook, all we're doing is taking the illustrations from the life insurance company, dropping them in here, and the returns are calculated. The illustrations themselves are not. These are calculated within the insurance company's software when we actually model these, and then we're just plugging this on Excel. But the numbers, the cash value and death benefit figures, we can't change in Excel because it's coming directly from the insurance company. So what do you notice here? Based on the current dividend rate, we're a lot better than 2.6%. You're at about 4.4%, which is much more powerful when I look at the taxable equivalent. Let me show you a bonus, and we'll wrap up with this. He looked at more than just these two options. So he actually looked at what is called a 10-pay. I should say we showed him this. Just in speaking with him, I'm like, I think he's going to like this. So even though he didn't ask for it, I would have wanted to see this if him and I flipped positions. So I'm going to show it to him. I like to have fun with this. All right. So this is a different product that a lot of people don't like, including myself. I do have one of these, but I'm not the biggest fan because of the upfront hit on cash value. Like look at the first year, 17% hit. But look at the long-term returns. The annual return is north of 5%, and this is a life insurance policy, meaning safe. We're not going to have market fluctuation. And then when I look at the IRR, that is attractive too. That gets above 4.5% over time. And when it hits that 4.6, he's up there in his late 70s and 80s. But my point is, this particular product is geared more so for cash accumulation from a long-term performance standpoint. I don't know if I'll actually pick this one. A lot of times people don't because they look at that and say, hey, the extra 0.5% or so that I see is great, but I like the upfront cash value with the other option, and I view that more as an opportunity cost, plus I've got stronger guarantees here. In any event, I hope you enjoyed this. This was a very detail-oriented case study. Would love to hear any thoughts that you have or questions. Please feel free to leave them in the comments below. And as always, I hope this helps. Thanks so much.